I was speaking to a friend of mine and he was telling me that Rahul, I'm paying 2000 rupees per month for a life insurance product from last 20 years. And if I invested that money into a mutual fund, even at 12% returns, today I would have had 20 lakh rupees. And I would have paid my remaining home loans debt free, happy days. To which I could only chuckle, but my response to him was that, mate, in these last 20 years, if you died without insurance, your wife and your kids would have joined 34 million people living in India below the poverty line. Because your wife and kids will need to repay your home loan that you're living right now sitting on a couch with an iPhone in hand. Comparing mutual fund with a life insurance is like comparing apples with lemons, because mutual funds grow our money, but life insurance protects our family. And that is the point most people miss out. In fact, term insurance is the first step to become financially independent. But the problem is most people make a lot of mistakes in selecting term insurance. And even if you already have a term insurance, the chances are that either you've got your amount wrong, or your policy duration wrong, or you're paying too much of premium. So in this video, what I'll do is I'll give you my step-by-step process of how to select the right insurance product, even if you already have it or whether you want to take a new term insurance policy. This video will massively help you, because in this video, I will talk about what is your right duration, what is your cover amount, what should be your add-ons, and many other things that you will enjoy. With that, let me straight take you to Policy Bazaar and filter out all the bad options so that we understand how to select the right insurance policies. Now, what you see on my screen is Policy Bazaar's website, and how I got to this page, you will find the link in the description. Click on that and simply enter your personal details. I have already entered them here to save some time because I want to come to the point here, right? So you'll come to this page and you will see a bunch of policies here, right? The first thing and the first biggest mistake that people make is selecting the coverage duration, or up to what age you need this policy for. So for example, if we come down here, I've selected 60 years right now, and that is giving me the first policy is roughly 1200 rupees per month of premium. Now, what should you really select here? Let us say if you want to go for 100 years of age, if you do that, what is going to happen is your premium is gone up to 3 times here. And even if you plan to live until 100 years of age, it is not necessary that you have the insurance for the age of 100 years. I will explain to you in a second, right? Now, if you look at the data here, we will see that close to 43 customers have selected 85 years as the age, which is a random selection in my view and makes no sense to me, right? So what should be this selection? In my view, it should be the age at which you want to become financial independent. Now, most people have no clue about what is the age they want to become financially independent. All they do is get up in the morning, go to their work, come back in the evening, have their dinner, have sex, sleep, and wake up again in the morning. Now, taking my example, I want to be financially independent by the year 2030. Will I get there or not is a second question, but at least I have that vision in my mind very, very clear. But if you do not have that vision right now, I would highly recommend you to have that in your mind and work out a plan to get there. Because it's not just about the term insurance you need that plan for. You need that plan to be able to live the life the way you want it, so that you can come out of this so-called rat race. Now, for the purposes of this demonstration, I'm going to select 65 years of age, assuming that you have no plans to be financially independent after 65 years of age. And if you do, then there is a fundamental problem with your income, your expenditure. I've created few videos around how to manage your money on my channel. Consider subscribing and liking this video, because these videos need to reach out to more and more people so that people understand a lot of viewpoints around money. The second big mistake that people make is in selecting the life cover amount. So here, for example, you have other options of 1 crores, 2 crores, 5 crores, 10 crores. And most people either end up paying unnecessary premium, or there are people who select the less amount, meaning that they are exposing their family for a financial hardship, right? What is the right amount here? We are not going to over-engineer it, but I'm going to give you a very simple framework that you can use, right? So how much should be your life insurance cover? In my view, what you do is first calculate your monthly annual expenses. So let us say every month you spend 50,000 rupees on your expenses. So your annual expenses are going to be 12 multiplied by 50,000, 6 lakh rupees annually. Multiply this 6 lakh rupees by a factor 20, you will get to 1.2 crores. So you need 1.2 crore rupees of minimum life insurance cover, but you also need to add any of your loans or debt. For example, if you have a home loan or car loan, let us say if you have all the loans worth rupees 50 lakh rupees, add that into this amount. So 1.2 crore plus 50 lakh rupees, that is 1.7 crores. Now take out all your investments such as mutual funds, stocks, gold, or property. Do not count your home that you're living in, right? Other than that, count everything that you have as your wealth and reduce that amount from that 1.7 crores. So let us assume that you have 20 lakh rupees of mutual funds or stocks or gold. Then 1.7 crores minus 20 lakh rupees comes out to be 1.5 crore rupees. So in that example, your life insurance cover should be at least 1.5 crore rupees. Now this is not over engineered, but the rationale here is that not only you have covered your family for next 20 years of expenses, but you've also taken care of all your debt obligations, and you've also considered your investments, so that all in all, you know what is the right insurance amount for you. Now you might say that, Rahul, you have not considered inflation into the expenses. Yes, I have not considered that, because the moment something wrong happens with you, your family is going to get a big lump sum amount, and even if they put that in FD and inflation is almost going to beat out each other, and you will still have 20 years of expenses with you. And as I said, please do not over engineer these amounts. Just go with this simple logic of covering your annual expenses plus all your debt obligations, extremely important point, and take out all your investments or wealth at that time, so that you get a rational figure of how much of your life insurance cover should be. Now you must do that calculation right now, even if you already have a term insurance, and think about how are you going to fulfill that shortfall if you have any shortfall. And if you're over that limit, then you might be unnecessarily paying the premium. Talk to your life insurance provider and discuss with them your options to reduce your premium. That will save a lot of money to you. Now, after selecting your duration as well as the life cover, the next thing we are going to do is we are going to go into filters. And the first option that we are likely to see is, how do you want your family to receive the money in case of unfortunate event, right? I always say that always go for lump sum amount, because what you want is that your family to receive all your sum assured amount in one lump sum go. And what they can do is, first thing, they will pay off any of the debt that is there on your name. Secondly, what they can do is they can then put this money into either mutual funds, gold, or fixed deposit or stocks, depending on their financial skills, so that that lump sum money starts to earn some passive income for your family. That is extremely important for you to make sure that that money that you are getting or your family is getting, it is also growing over a period of time. So take lump sum payout option here. The second thing that you will see in terms of filters is select a plan type that suits you the best, right? Here, one very, very interesting option nowadays few insurance providers are offering is increasing cover plan. So I want to walk you through that plan very, very quickly. Let's select that and let us click on apply. What you see, only few insurance provider, I think there are only 3 or 4 right now in this filter that has come up that are providing this option. What is this option? Very simply, click on this payout increment, which is 10% every 5 years. Simply means that at the age of 30, in our example, you have a sum assured for 1.5 crore rupees, but after 5 years, this 1.5 crore will automatically increase by 10%. So 10% of 1.5 crore is 15 lakhs. It will go up to 1.65 crores and so on. So every 5 year, your sum assured amount is going up by 10%. Now this percentage will vary depending on the policy that you take. But what this essentially is doing is that you are covering yourself for the life stages that you might undergo. For example, if you're very young, you are at the age of 25 or 28 or 30, you are likely to plan for kids, right? So let us say at 35, you're going to have 2 kids, right? Now you need to make sure that you are provisioning for all these life stage events so that all your obligations are met in the right timely manner, right? So having this increment in your cover will safeguard you from these life stage events. Other option is that at the time when these things happen, like you plan your family or you take any extra loans, you might go for increasing your sum assured amount at that time. But the problem with that option is that not many insurance providers give you a very clear direction of how you can go about increasing the base amount. B, you will have to pay additional premium at that time when you want to do it, right? Here in this option also, we are paying a little bit extra premium, but what you're doing is you're securing your life stage events from a protection perspective. Extremely important point here. But if you know that your life stage events are not going to change, because for example, you are at the age of 40 already, right? You already have your family, you already have your home, you know that you're not going to take any more loans, then it's fine that you don't go for this option. This option is very, very important for young people and people who know that in their life, in the next 10 years, 20 years, there are going to be substantial life stage events that is likely to increase their sum assured amount. Therefore, go for this option right now. Let's come out of it and go to some other options. So if you go to filters here and have a look at, let's say, another very, very interesting feature is this selection here. So let us select that here and apply. Now what this option simply means is that you are going to get all your premiums back at the age of 60 years of age, right? Now the catch here is that this option is only available if your policy duration is more than 65 years of age. But if you want to be financially independent before 65 years of age, you don't need the insurance for more than 65 years of age. So therefore do not select it just because you want to get your all the premiums back, because it's very, very important you to stick to the age you want the policy for, not go with this premium back policy feature. And the second important thing that we must do is look at the premium amount. So your premium amount, if you go for this option, is going to be slightly higher. So you need to do the calculation of time value of money. So let us say you're paying 1000 rupees per month without this option. And if you're paying 1500 rupees per month with this option, then you're paying 500 rupees per month as an additional amount, right? So what you need to do is look at your policy duration. Let's say your policy is for 20 years, and this 500 rupees per month, if you put that in a mutual fund, even if at 10% interest rate, for the next 20 years, how much of money it is going to generate versus the premium that you are going to get back after 60 years of age. Compare those two figures and you will know yourself whether you should go with this policy or not. Let me now explore one last option here, the point that you see, save up to 49%, right? So let us go ahead and click on save up to 49% and you will see this option coming up here. And what it simply means is that if you pay for this policy only for 5 years, you are going to save up to 49% versus you continue to pay this premium up to the 60 years of age, you're not going to save a lot of money. So let us click on 49% here, say save money now. Now you will see, for example, for the first policy here, the premium has gone up because you're paying all of this money into the 5 years only rather than pay until the entire 60 years of age, right? So what we are going to do is look at this effective saving here, 40%, click on that. And now it shows you the comparison here, right? So what it is saying is that if you continue to pay regular pay, which is 1450 rupees every month for next 35 years, then you are going to pay 6.75 lakh rupees. But if you're paying for 5 years, then you're paying 5,760 rupees every month. That will take you to 3.94 lakh rupees. So essentially you are going to save 2.8 lakh rupees, right? But what I'm saying here is that you are paying additional money. So 5.76 minus 1.45, it comes out to be 4,310 rupees every month you're paying extra. If you put this money in a fixed deposit or a RD every month, 5 years period, 7% FD return, you are going to get 3,10,000 rupees back. Of course, you will have to pay tax on this 3,10,000 rupees, but you are still going to be better off than saving 2.8 lakh rupees as was shown here, right? Now, let us say that if rather than 7% return, even if you can do mutual fund investing and you get to 10% returns, this money of 4,300 rupees every month is going to become 3,36,000 rupees after 5 years. So you are much better off by opting for payments until policy elapse rather than paying here in lump sum amount, because that is not a good option for you from a time value money perspective. So far you have seen few good parameters that will entirely change the way you select term insurance policies. And if you want to compare insurance policies, I will also provide you the link for Policy Bazaar in the description or in the pinned comments. Go ahead and check out yourself. If you found this video useful, share it with your family and friends and let me know in the comments a simple thank you, and let me also know whether you want me to continue bring you this knowledgeable information about insurance products. Let me know in the comments and I will do my best to bring you part 2 or part 3 of these videos. With that, I will see you in my next video. Until then, keep rocking.